Being in supply chain, procurement, operations, logistics, I'm sure you have heard about the income statement or the profit and loss statement or the P&L. But what is it? A P&L can be historical or forward-looking, a projection or an estimate. Both the cash flow statement and P&L are fundamental. Showing one without the other one is like having mac and cheese without the macaroni, or the cheese, or having peanut butter jelly sandwich without the peanut butter or the jelly. You get the idea. A P&L shows the income and expenses for a period of time, and it follows the accrual accounting method. What was that, Marcia? The accrual accounting method? It means that finance records the transactions based on receipts and deliveries of materials products and not based on cash payment, not based on cash ownership exchanges. The P&L shows the profit or loss. The focus is on performance of the business, and it has a similar structure than the one that we find in the cash flow statement: operating, financial, and tax activities. Supply chain and procurement have a huge impact on revenue, COGS, gross profit, OPEX or operating expenses. Let's take a look now at each component in the P&L. Revenue is the top line in the P&L. Traditionally, supply chain was associated with cost reduction or cost containment. But supply chain goes beyond cost savings. Supply chain and procurement have a critical role in the growth of a business by orchestrating the multiple moving parts from raw material acquisition until delivery to the customers we want to delight. Not considering the impact of supply chain on revenue is leaving money on the table. Marketing may sell the moon, the stars, the sun with delivery in 24 hours. But with no product to sell, there are no sales. Instead, there are disappointed, angry customers. Angry like angry birds kicking and screaming for worms. COGS or cost of goods sold. COGS includes all the necessary costs to get your product ready to sell to your customers. It includes raw materials, ingredients, components, freight in cost, plant labor, and factory overhead. Production cost or factory cost can be split into direct and indirect cost. Direct cost is when we can assign that cost to a specific product. For example, if we run the line to produce barbecue chips. As this cost we can assign to these spicy sweet chips, it is a direct cost. An example of indirect cost can be factory supervisor. It cannot be assigned to a specific product. Another example of indirect cost is the utilities that are included in the factory overhead. Production cost can also be split into variable cost and fixed cost. When production increases or decreases, variable cost will change in the same proportion. Let's say that we wanna double the production of the barbecue chips. In that case, the ingredients, packaging, the labor will double too. Fixed cost do not change with increases or decreases in production. Okay, there are some cases that they do change, but not in the same ratio or proportion. Let's consider the salary of a factory supervisor. It won't change if we double the production of barbecue chips. But as I said, Sometimes the supervisor needs to work more. Let's say that the supervisor works overtime. In that case, yes, there's an increase in fixed cost because production has increased, but it's not in the same proportion, it's not double in the example that we are following. Gross profit. Gross profit is the difference between revenue and COGS. Some companies also calculate the gross profit percentage, that is, the gross profit divided by revenue. Remember that this is not what the company gets. There are other costs, other expenses like operating expenses or OPEX, as you may have heard. OPEX include selling and administrative, rent, utilities, services, and indirect purchasing or indirect procurement plays a major role on OPEX when they negotiate, for example, contracts with service providers like SAP or Oracle. Operating income or operating profit. This is the net earnings from the core business. The focus is on performance, and the calculation is revenue minus COGS minus OPEX minus depreciation minus amortization. A positive operating income means a positive result, a good performance. When it is negative, that means that from the core business, costs are higher than revenue. The company is not performing well. That's not good. Other income. This line in the P&L shows the proceeds that don't come from the main activity. For example, if the company sells a packing machine when the packing machine is not the main activity of the business. Interest and taxes. A company finances its operations with a combination of debt and equity. This is the capital structure. When the company has some debt like bond issues or get some loans, in those cases we are gonna see in the P&L interest expense. This interest expense is because of the financing of the company through bond issues or any other kind of loans or any other debt. Now, this is not what the company makes. It's not that the profit is after the interest that the business pays. The business will also need to pay federal and state taxes. Oh yes, the IRS will get its portion, net profit or bottom line. Now, this is the moment of truth. This is the finished line. This is the to be or not to be from William Shakespeare play Hamlet. These are the profit that the company makes after paying interest and taxes. If the result is positive, the company may distribute or may reinvest. If instead the company gets a negative result, that means that the costs are higher than revenues. If you like this video, I'm sure you will like the video. I included the link in the description that talks about the cash flow statement. And if you like this video or the cash flow statement, please smash that like button and subscribe to my channel for more videos like this one, where finance and supply chain intersect, and you can learn how to financialize your supply chain planning.